Ladies and gents, Bratt here with your San Diego County real estate market update. In this video, we're going to go ahead and take a look at the standard numbers that we always do. But, this is April 11th, 2020, and we are in the midst of COVID-19. So this is going to be a bit different than most videos in the past. But like I said, we're going to start off with the standard numbers that we always look at for what that's worth. It hasn't even been a full month. We only went into lockdown, I think, March 19th. So the data we're going to be looking at is mostly through end of March. So that's not really going to be very indicative of where we're at, but we're going to take a look at that. Then at the end of the video, we're going to circle back around. We're going to talk about some factors that will influence the real estate market in San Diego. And then I'm just going to give you some quick clip notes on my thoughts as far as the actual implications of this in real estate going forward. I tend to think a bit clearer on paper and be able to put my thoughts in a bit more flowing of a manner. So what I actually did is I did a written report on this as well. So if you'd like a copy of that, which might be a bit more, a bit easier to understand, I apologize, I'm a bit scatterbrained in these videos. Feel free to shoot me an email at info@therealestatejedi.com. I'll put the email in the description below. Shoot me an email there. Put subject as something like COVID-19 real estate market update or something like that, and I'll send that over to you, okay? So bear with me. I'm going off some notes here throughout this video, but in the meantime, let's go ahead and get started. Let's take a look at the numbers, and then we'll circle back around real quick.
So starting off looking at active listings, for what it's worth, month of March was down 28.5% year over year in active listings. New listings was down nearly 20%. Pending sales were down 21.5%, and sold listings were down a point and a half. Again, I think the shutdown went into effect around March 19th, if I recall correctly. So towards the end of the month, and we really haven't had nearly a full month to really let this set in as far as what that means for sales data. But I could show you some specific charts, which I'll pull up here in a second, or some specific numbers that'll show you that we definitely are going to be feeling this, especially when we look at all of April's numbers. Dollar volume was up nearly 10%, rather. And active market time is down 25% year over year. Sales price, we're still up 6.7% year over year in San Diego County. So yeah, really nothing to mention as far as the impact that was felt in March numbers quite yet. If we're to look at these quick glance stats for the stats of the week, just here in the beginning of April, these numbers are significantly depressed from where we were the previous week and the weeks before that. So we're definitely going to see a significant shock in numbers due to the shutdown in April. But for right now, really the data we're looking at is primarily through the end of March. And I'll try to give you a periodic update here on this too, here in the next few weeks regarding more accurate numbers as far as what's going on in April. But right now, there's fewer properties coming on the market. There's fewer properties going off of the market, which does still open up a great opportunity for serious buyers who want to go out there and capitalize on the properties that are for sale, because those ones are most likely they need to be sold. Okay, let's look at a few other things here. The impact of COVID-19 on real estate showings in North America. If we look at the chart for California, we can see that just starting end of March or halfway through March, showings just absolutely plummeted here. Okay, we are down nearly 70% in our actual showings. So this is, you can see this is just going to completely freeze up market activity. 30-year fixed rate mortgage. We can see we dropped to as low as 3.29%, 30-year fixed average across the country. Spiked back up again because there was an influx of demand for refinances, and there was a lot of crazy stuff going on with the mortgage-backed securities market. And we've kind of settled down again. We're definitely down to lower rates, but we're still not as low as we saw for a very brief period of time. A couple days, there was absolutely ridiculously low rates. But I do expect that hopefully these rates will continue to stay low. I don't think that there's any major increases on the horizon at this time. The St. Louis Fed Financial Stress Index, just for reference, this is kind of an indication as to what the stress rate is essentially, and the average American family across the country. And you can see in 2008 we spiked up to nearly 9 or nearly 10. We spiked up pretty significantly here to just about 5.48, but we dropped back down again pretty quickly. So we still haven't experienced the same financial stress here as we did in 2008. I think the stimulus is going to be definitely a safety net for the economy in general. And that's definitely going to ease this, because if it wasn't for that, I think this would be much, much higher. Weekly mortgage applications sunk nearly 18%. So there's, like we already acknowledged, there's definitely a decrease in real estate activity. Unemployment claims near 17 million. The unemployment jobs report was absolutely ridiculous. I mean, if we look at I don't know if it has a chart on. I don't think it has a chart here going back decades and decades. But if we were to look at a chart compared with 2008 or the Great Depression, I mean, we are absolutely well beyond that. This is the major spike. To have a spike of these unemployment claims near 17 million, and there's still anticipated to be a lot more because the systems were so backed up. So many people were actually claiming unemployment. But I'll address this later on, and I'll give you my take on it, because I don't know that these are necessarily accurate as it pertains to what to really expect after this is all done. Out of these, California most recently had about 925,000. Prior week was 1 million, and prior to that was 400,000. So we are about just over 2 million out of these 17 million jobless claims. So definitely a good handful that is coming from California. There's a NAR Flash Survey done just to kind of get a feel for what agents are seeing and what sellers are doing across the country, buyers and sellers are doing across the country. Sellers reduced listing prices due to COVID-19. 72% have not lowered the price. 8% said yes by 5 to 10%. 16% said yes by less than 5%. And we really haven't seen any major increases yet on major price drops. Tenants paying rent. Those that are managed by property managers, no issues with collecting rents. 46% said there's a delay in paying the rent, but they're going to be accommodating knowing the circumstances. 21% are saying that they're going to be delaying paying the rent, and it's going to be difficult for them to actually follow through on this. You can see the numbers are a little bit different for individually self-managed properties, but nonetheless, the general consensus seems to be that the majority is either going to be paying the rent on time and or are going to be paying a little bit late, but still anticipate being able to pay it on time for April at least. Buyer interest. 90% of members cited a decline in buyer interest. 45% of members reported a decline by more than 50%. 8% of members cited no change in activity. So you can see there's a major chunk of buyers here that really their interest is dropping off a cliff. But of course, there's not nearly as many properties to go out and view. A lot of sellers aren't allowing people inside their home nearly as readily as they would previously. So there's a lot of obstacles to that. But nonetheless, again, difficulty and uncertainty creates opportunity. So being that there's a lot of other uncertain buyers out there right now, this might be a great opportunity to take advantage of that. Buyer expectations of home prices. This is interesting. 37% are expecting not any decrease in prices. 16% are saying they expect a slight discount on home prices coming up, less than 5%. 23% say they expect something 5 to 10%. 9% say 11 to 15%, and 15% expect more than 15% of a decrease in prices. Buyer behavior, though, see, here is where we're really going to see how this is actually going to just be kicking the can down the road. 59% of members reported buyers are delaying their home purchases for a couple of months. Okay, so we're going to see a wave of buyers coming back on the market here. 13% reported members are continuing the process, but only relying on virtual communication. 13% reported clients are deciding not to buy or sell indefinitely. So only a small portion of this, relatively speaking, are actually deciding to step back and say, you know what, I don't think we're going to be buying or selling at this time. But I do think that once the economy opens back up again, I think buyers will become a bit more certain with their intentions, whether that is permanently putting off their home search for the foreseeable next few years or jumping back into the market. I think this is going to, I think the uncertainty here will definitely dissipate once we have more certainty, of course, in the state of the economy. Now, of course, due to the major government stimulus that we added onto our balance sheet, we are at over $24 trillion in U.S. national debt now. How this proceeds to impact our country and inflation and a number of other things remains yet to be seen. But I will address that later in this video as well.
All right, so where's the San Diego real estate market where we are at right now? Well, first and foremost, real estate is classified as essential in California. Therefore, sales are still happening. Properties are still being listed. Buyers are still buying properties. But of course, it's to a majorly drastically reduced effect, right? Drastically reduced quantity, right? We're still listing properties. We have 3D Matterport tours, so you can essentially explore a home in complete 3D. We can market the property amazingly digitally, just like we've done before, and really make it as close as possible to somebody being there without them actually being there. But, to be fair, a lot of, that's not going to do it for a lot of people. So a lot of buyers are still on the sidelines. And they don't want to be going out and touring properties for the same reasons. A lot of sellers don't want to put their properties on the market and have a lot of strangers come through their property right now either. So there is definitely a slowdown in the number of properties coming on the market, as well as the properties going off the market. You could see that in the pending sales drop just in March. But for the most part, everything is on hold right now. We know the entire economy is on hold. Real estate's still continuing to happen to some extent, but it's at a much diminished extent. Let's quickly look at potentially impactful factors in the housing market, especially the ones that are coming, that are coming out of this COVID-19 crisis. Okay, first and foremost, demand. So let's look at jobs and unemployment, which directly affect qualified demand. Unemployment claims were over 16 million in the last weekly report through April 4th. Just 2.4 million of those, roughly, were from California alone. My feeling on these, I'll explain later in the video, but I have a certain hunch on these. Okay, that's a major spike though. I mean, if we look back to the Great Depression in 2008, those are like little blips compared to this major spike we just saw, unlike anything we've ever seen. Migration patterns. Who knows if this is going to accelerate the negative migration pattern out of California or if it's going to put it on pause. I don't know how this is going to affect that. But potentially, maybe people are going to come out of this and they're going to say, wow, that was a really close call financially. I don't want to be in this situation again. I'd much rather move my assets to Florida or Texas, where I have a much healthier cushion of safety financially than I do in California based on the taxes and home prices and everything. And so that very well could be the case. I don't know if that's going to be an end result here, but I think that it potentially has the capability for accelerating that negative net migration out of California. That will directly have an impact on demand if that is impacted there. Potential surge of qualified buyers that are waiting until this blows over. Like I said, there's a lot of buyers that are waiting on the sidelines to jump in. I think right now is a good time for buyers that want to go and negotiate good deals, at least relative to the environment that we were in before. If you need to buy a property, you're going to buy a property in San Diego regardless. I mean, you're going to be putting your money towards housing somewhere. If you're not going to be moving out of the state and you're going to be buying something, now might be a very good time to go out there, because with uncertainty comes opportunity. And I think right now there's a lot of uncertainty still, especially in the minds of sellers. Sellers that are selling right now pretty much need to sell. And if you're going out there as a buyer saying, hey, I see your property has been on the market 2 weeks, that might be a long time in today's market. So, they might be open to taking something that they otherwise would not have taken just a few weeks back. Now, don't get me wrong. There's still a lot of properties that are getting multiple offers right now. We are getting, I think actually in all of our active listings right now, we've pretty much gotten multiple offers. But those are really priced well. And I do think that, even if you're only competing with 2 other offers right now, compared with competing with 5, as a buyer, you're in a much better position, technically speaking, compared with where we were the last many years. Affordability. This is another impact on directly affecting demand. Interest rates. As of right now, interest rates are low. There's a lot of crazy things that happen with interest rates and the lending sector. If you've not seen, the whole market started panicking when COVID-19 started really blowing up in the United States and Italy and everywhere else, and treasuries tanked, and mortgage-backed securities tanked, and a million buyers flooded to the lenders and started applying for refinances, because I had clients that were locking in 2.75, 2.875, no points, 30-year fixed mortgages absolutely nuts. Unheard of rates in the 2%. I made a video on that 6 months ago too, which is interesting, and it's crazy. Like, we actually hit 2% interest rates. Bruce Norris is really a big proponent of that, and I followed a lot of what he said, and it's true, because when you just follow the money and see where things have to go, interest rates are only going to go lower so long as the other factors of the market play as we would expect them to play. So, I mean, now here's the other caveat to that. We saw also a major jump back in prices as soon as they went up, because all of a sudden then mortgage-backed securities, investors that were either buying bonds, federal bonds, or federal treasuries, or mortgage-backed securities, said, whoa, what are the prospects of mortgages defaulting and buyers not making their payments? So the prices on those actually tanked and rates spiked. And there was also such a major influx of the refinances that most lenders are like, dude, we are at capacity. We don't need to incentivize anybody to come and get a loan through us. We can't handle any more business. So therefore, here's our rate sheet, 4.5%, whereas maybe based on what the 10-year federal treasury rate is, you might think that you'd be getting a 3.5 or a 3.25. But nope, there was a lot of crazy stuff going on in the bond market. And then there was also a lot of crazy stuff regarding the liquidity of mortgage servicers, okay? And I don't think that's going to be an issue. I think that the federal government is going to give liquidity, a line of credit for these mortgage servicers. This is for another video, but the bottom line is, with all this talk about you don't have to make your mortgage payment, you're not going to be evicted, you're not going to be foreclosed on for at least the foreseeable future, there's a lot of panic in the mortgage and lending space, because mortgage servicers who don't necessarily own the note, they are still required to make their payments to their investors who do own the note holders, whether or not the borrowers make those payments or not. So there was a lot of panic saying, hey, what if these borrowers just start defaulting and they're getting this bad information that they can just stop paying their mortgage? And there wasn't really a whole lot of hand-holding, other than a lot of explanation as far as that goes, other than, oh yeah, we're giving these incentives where you're not going to have to make your payments. And there was a lot of panic that, well, they weren't giving any instructions, and what if buyers just start defaulting on their mortgages? And then the mortgage servicers who operate on a very small margin don't have the funds to pay their note holders. They could absolutely go bankrupt. It could be a major lending crisis, which it could be. But I do think that based on what the Fed has done for every other sector, what their openness and publicity in saying we will do whatever it takes to pump liquidity into the system. We are not going to let the economy seize up. We're going to do everything in our power to keep this economy going strong. I think that they're going to offer those credit lines, and I think they already did. I think I saw an article saying that they're already doing that, beginning with Penny Mac, which is a major loan servicer. So that said, yes, as far as interest rates go, I do think that liquidity being pumped back in there is going to allow rates to once again settle down to lows. I think that interest rates are going to remain low. I don't think interest rates are going to go up significantly, and by significantly I mean at least half a point or more in the coming months. I think this would be a horrible time for that to happen, and I don't think that the Fed will allow that. Lending restrictions. Now, during this lending crisis and the panic here, there's a lot of lenders that did start tightening their overlays, their lending requirements. So they started adding additional requirements, for example, higher FICOs and lower debt-to-income ratios, and things like that could potentially have a negative impact on the buyer market. So maybe if 10% of buyers had FICO below 620, for example, then if all of a sudden all lenders start adding overlays that they're only going to take 680 or higher on the credit scores, then that could potentially diminish the buyer pool. Supply and inventory, potential spike of listings that hit market once this is over. As far as supply goes, so we already talked about demand. Now let's look at supply. So, are there a lot of sellers sitting on the sidelines waiting to list their property? You betcha. I think that's absolutely goes without saying. A lot of people don't want strangers coming through their property and touching everything. But I also think a lot of buyers are doing the same thing as well. So whether or not that's going to be disproportionate, I don't know. I think that this is going to be directly tied to the length of the shutdown. I think that if the shutdown lasts for past June, I think every single month, well, I think right now every single month, but essentially, especially after a few more months, which I think people already kind of have priced in, that's the expectation of everything. I think if it goes past June, this major shutdown, I think things are going to start really deteriorating much faster. I think there's going to be a larger number of sellers that are going to need to sell because they're in a poor financial situation. And I think the buyer pool is going to be much lower because not as many buyers are going to qualify. So that could very quickly deteriorate the housing market, but I don't anticipate that happening as long as we don't stay in shutdown for much longer than June. Now, the question is, can this stimulus really be effective without damaging the economy? Can the Fed just add all this money to our balance sheet and pump all this money into the economy without there being some negative major side effects such as hyperinflation? And if you are a follower or believer of modern monetary theory, MMT, then that suggests that adding to our national debt, so long as it is denominated in our own currency and is not too great with respect to available resources and the ability to support the debt, then it will not lead to inflationary problems. Whether or not you believe that, I don't know. There's some very, very smart people that think that's rubbish, and there's some very, very smart people that think that is absolutely sound, and we're not going to have any issues. My thoughts on this, though, overall right now is I think the Fed stimulus in the short term is definitely beneficial. I think that without it, I think we are all on the same page. There would be a major economic crisis to the likes of the Great Depression, if not greater. When have we ever stopped the economy and then just tried starting it up again? We haven't. So this is all of pretty much an experiment, and it's all really hypothetical until we actually experiment with it and see how it works. But in theory, my feeling is that the size of the stimulus, the general sentiment is very positive. I think especially in San Diego, we are very resilient. I think that the American people are very resilient, but I think in San Diego, I think that we are poised to spring back. I think one of our saving graces for the real estate market is the lack of supply. And we've had this lack of supply, and it's only been getting worse for many, many years now. Now, of course, like I said, if there's major changes in lending restrictions, or if this goes on for longer than expected, and we have sellers that are desperate to sell their homes and are willing to take a lower price, or a major dwindling of the amount of buyers, then this could definitely potentially impact the market negatively. But I think that for right now, even if we were to have an increase in inventory and a decrease in the buyer pool, as long as interest rates stay stable and the lending restrictions aren't too drastically further restricted, I think that we're going to be okay. I think we're going to spring back. And a few weeks back, when we were just getting started on this, we had conversations with all of our buyers that were in escrow. We said, hey, I think that there's a good potential that housing prices will be negatively impacted in the coming months, possibly years. Do you still want to move forward? And the majority of them actually said yes. But that was a conversation I thought was necessary to have. And now I'm actually much more optimistic as long as we don't go into this much longer than need be, right? Like I said, as long as we're not going past June, I remain pretty optimistic. I don't know what these actual unemployment numbers are going to look like, but this is my feeling, is that the majority of these unemployment numbers that we see, the 16 million nationwide, 2.4 million roughly in California alone, I think that those are overinflated because I think that those are mostly furloughs. I don't think that those are actual layoffs. I don't have any scientific data to back that up. But if we look at the incentives and the reasons that you might want to file for unemployment, they open it up with this new stimulus bill to include self-employed. They opened it up to include people that just had their hours reduced. So even if you're still employed but your hours are reduced, then you could potentially be eligible. They even allowed it for gig workers, right? So Uber drivers, Lyft drivers, things of that sort, freelancers. And also they added an additional $600 per week to anybody qualifying for this. That's $2,400 a month. The survey was done, and it's expected that 70% of people eligible for unemployment are actually going to be earning more in the short term from unemployment than they were going to be at their job. So why in the heck would you not file for unemployment if you can meet the criteria? So because of that, I do think that a lot of these are furloughs or temporary situations. I think people taking advantage of the system, which I'm not saying is anything wrong with that. I mean, our economy's on standstill, and the government's telling us to do this, so I think that that's right. That we have to support there, but I do think that is going to come down drastically. I think that comparing numbers from the Great Depression or from 2008 is not fair looking at unemployment, because it's just not the same thing. It's not apples to apples. You have much more laxed standards for qualifying for unemployment right now, and I just really don't think that those numbers are realistic and indicative of where our economy is going to be. Now, could it still be significantly high? Could it still be several million, maybe not 16 million? Could it be 2, 3, 4 million? I don't know. I have no idea. But I just don't think it's going to be nearly as drastic as that. I think even if it is, I think it's going to spring back significantly. Now, don't get me wrong. I do think that we're going to have an economic hit. I think in San Diego we're going to have a hit. I think in everywhere across the country. And I don't mean like to our GDP, that's like goes without saying. But I mean, I do think that there's going to be, unfortunately, many small businesses that are going to be out and about. I think that what this thing did is it accelerated the direction we were already going. Because if you look at this, like Amazon, they're thriving still right now, right? People are still buying stuff on Amazon. I just got 5 things delivered earlier today. I mean, and I think they're back on track too. They were kind of backed up, but I think that Amazon is actually thriving. I think that Netflix, Zoom, all of these digital companies that have these large margins of safety in their business model now are just dominating even more, right? So it's like the big businesses that had that security already baked in, they're the ones that actually had the upper hand now. And unfortunately, I think they're just going to be taking more market share from all of this, and the smaller guys are going to be squeezed out more, unfortunately. But I do think that that's kind of what happened here. I think that this is really an acceleration of what direction we were already going in general. But nonetheless, so as a whole, I think the economy will recover, but I think it's going to look differently than it is right now, right? It's definitely going to be restructured. Things are definitely being restructured. But I do think that some of the smaller businesses that didn't have that same safety margin are definitely going to feel it. There's going to be businesses that are going to go out, unfortunately. But I think they're also going to recover too, because we're very resilient people, right? Everything we go through makes us stronger. I'm very optimistic. I'm very confident we're going to be much better on the other side of this, whether that's 3 months, 6 months, or 5 years from now. I don't know when this is all going to be over. I don't know if we're going through a temporary thing and then we're just going to be like, oh, okay, we'll bounce back to almost normal life, and with the exception of 6 feet distancing and everything. I don't know if that's going to be the case, or if we're still waiting for reality to set in. But this is my take on everything. I really do think that as a whole in San Diego in the short term we're going to be okay as far as real estate goes, even if we take a little bit of a hit. I think that we have low inventory is our saving grace. In the long run, I think that I think that the legislature's policies, for example, we've talked about this many times, the proposal of rent control and the actual implementation of rent control involuntary, even though 59% of Californians voted against it, the attempt to get a partial repeal of Prop 13 on the ballot, things like this things like this are definitely going to be factors that buyers are going to consider when they're looking at whether or not they want to stay in California, move to California, or move to another state. So that said, I'm still conservative on that, cautious on that rather. But I think in the short term, I think that the San Diego market's going to be okay. I think we have a lot of great things going for us. I think the hedge of having the military and government sector in jobs here in San Diego, from the Navy and Marine Corps, government contractors, healthcare, bio companies. There's a lot of great stuff we have going for us in San Diego, and the housing shortage is just more than is easily going to be. We're not just quickly all of a sudden going to satisfy all the housing demand in San Diego. So even if there was an influx of supply, that's actually going to be okay. Even if prices were to soften, I don't think that they're going to take a major hit. Again, barring an extended shutdown beyond June, barring any major further restrictions in credit, and barring any other complications, unforeseen complications in all of this, such as the stimulus not actually coming through as promised. Things like that could absolutely throw us a major curveball. But that said, guys, I am very optimistic. That's where we are right now. Next month, we're going to have a much better idea as far as what data during the shutdown is actually looking like. But in the meantime, I hope this was helpful. As always, thanks for watching. And like I said, if you want a paper copy, it's not the most sophisticated report in the world, but it's just me outlining my thoughts on paper. If you want that copy, I'll send it over to you. Just again, shoot me an email, info@therealestatejedi.com, and I'll get that over to you. As always, thanks for watching. If you haven't already, subscribed, and I'll see you in the next video.